Good morning, everybody, and welcome to this webinar where we're getting ready for 31 December 2018. Now, this is our November webinar, our 11th one, therefore, for the year. What will we be covering today? Outline of this webinar. We'll be looking at regulatory changes for for-profit entities, and some of those are really hot off the press and were only issued on Friday last week on the 16th of November. Then we'll look at a number of regulatory changes for not-for-profit entities. In the third section, we look at some of the focus areas of the regulators. Now, ASIC has not issued their focused area for 31 December yet, so I'm basing this discussion on their focus area for 30 June, but I've also looked at some of the other global regulators and what they've published as their focus areas. So a little bit of an overview, a global overview of the regulators in general. Then in the fourth section, we look at the accounting standards that are effective for the first time for financial years ending on 31 December 2018. In the next section, we look at accounting standards that's been issued, but they're not yet effective for 31 December, so I won't discuss them extensively. I'll just list them. We'll look at them in a few months' time when they're more relevant for us. And then I'll end the session with IFRS 23. Now, IFRS 23 around uncertain tax positions and accounting for uncertain tax positions are not effective for 31 December 2018. However, there's been such a lot of discussion and debate of this particular interpretation that I thought I should spend a little bit of time on it, and therefore we leave it till last. So that's the outline of the webinar and how we've grouped it together, and we hope you find that useful. So if we look at regulatory changes for our for-profit entities, I just want to, just for a second, have a look whether I've got everything the way I should have it. Yes, perfect. So if we look at regulatory changes for our for-profit entities, the AASB have issued invitation to comment 39, and they asked for comments on that particular document in two phases. The first comments related to public interest entities or listed entities, and that was due much earlier in the year, I think around August. And then earlier in November, they asked for comments on phase 2. And that's particularly where they looked at the conceptual framework project, how it applies to for-profit entities that are not public interest entities. So all for-profit entities that are not listed entities in a basic way. So they were not considering how the conceptual framework will apply to not-for-profit entities. Now, first of all, what is this proposed change in ITC 39? What they're proposing is that if an entity is required to prepare financial statements in accordance with Australian accounting standards, then the entity has to prepare general purpose financial statements. That's what they're proposing. Now, as you know, currently we have a SAC 1, and entities will in the first instance consider whether they're a reporting entity or not, and it flows from there. Now they want to change that. They want to remove SAC 1 and say going forward, the criteria will be, do you have to prepare financial statements in accordance with Australian accounting standards? That's the criteria. If the answer is yes, you have to prepare general purpose financial statements. And if the answer is no, then you can continue to do special purpose financial statements. Now, which entities are usually required to prepare financial statements in accordance with Australian accounting standards? Now, first of all those entities that are required to lodge and therefore have audited their financial statements with ASIC have to prepare those financial statements in accordance with Australian accounting standards. So this is a big change because there are a number of entities, more than 80% of entities who currently lodge financial statements with ASIC, apparently lodge special purpose financial statements with ASIC. So this would mean each and every entity that are required to lodge those financial statements with ASIC will have to lodge general purpose financial statements with ASIC. The second bullet point there is who else are required to prepare financial statements in accordance with Australian accounting standards. It could be that your regulator requires you, for example, ASIC or the ACNC. It could be there's specific legislation that requires you to prepare financial statements in accordance with Australian accounting standards, and I'm thinking significant global entities as an example. It could be that your trust deed currently says, in accordance with this trust deed, you have to prepare financial statements in accordance with Australian accounting standards. And maybe your bank in their loan says prepare financial statements in accordance with Australian accounting standards. So those are a few examples. But the critical thing to look for would be, do we have to prepare financial statements in accordance with Australian accounting standards? That's the question. It will no longer be, are we a reporting entity or not? And a big reason for that change is they no longer want entities to self-assess whether they're a reporting entity or not. They want to make it very clear. Do you have to prepare financial statements in accordance with Australian accounting standards? A very clear yes or no, and then we know what the answer is. Do you need general purpose or not? So these proposed changes, we're looking at for-profit entities. As I said, that are not listed entities. They were not considering not-for-profits at this stage. Now, if an entity is currently preparing special purpose financials, and after this comes into effect, if it's approved, it's only an invitation to comment. It still has to become an exposure draft, and then it has to become a standard. It's a long journey, but if it's approved, what would the implications be? If you're currently doing special purpose and now you have to do general purpose. Now, the first implication is that you'll have to comply with all the recognition and measurement principles of all Australian accounting standards. So each and every debit, credit, fair value, everything will have to be complied with. Now, the next bullet point is actually the huge one, and that is general purpose financial statements would require the preparation of consolidated financial statements. I think a lot of entities currently, when they prepare and lodge special purpose financial statements with ASIC, although the ASIC regulatory guide says you have to comply with recognition and measurement of all accounting standards, they argue that consolidation is a disclosure standard and they don't consolidate and only lodge parent entity accounts with ASIC. Now that's going to change. General purpose financial statements will include the preparation of consolidated financial statements. So if you're currently lodging parent entity special purpose financial statements with ASIC, that will turn into consolidated financial statements. Now, the third area is around disclosure. Now, disclosure, you could do tier 1, so that's all disclosures of all Australian accounting standards similar to listed entities, or you could look at tier 2, which is some form of reduced disclosures. And on the next slides, I look at the two possible tier 2 alternatives. So the AASB asked whether entities would like to continue with the current reduced disclosure RDR regime for tier 2, or whether entities would be more interested in a specified disclosure regime, an SDR regime. And currently they're thinking that specified disclosures would mean you have to do recognition and measurement of all standards, and then you do all the disclosures of AASB 101, presentation of financial statements, 107, cash flow statements, 108, changes in accounting policies, 1048, the related interpretations, 1054, the specific Australian additional disclosures, as well as all the disclosures of AASB 15 around revenue, AASB 112 income taxes, AASB 124 related party disclosures, and AASB 136 impairment. Now, the key difference between these two alternatives is that RDR would require you to do a few disclosures from each and every standard. And how you know which you have to include and which to exclude, if you look at a standard, the disclosures that are grayed out or shaded grey, you don't have to comply with them for RDR purposes, but all the others you have to comply with. So RDR disclosures are spread over all the accounting standards, where specified disclosure requirements will only be looking at 9 standards, but it would be all disclosures in those 9 standards, and not only selected disclosures from those 9 standards. So the AASB has requested comments on ITC 39. The AASB had a number of round tables where they've discussed it, and we're now awaiting their decision on next steps. At the same time, Treasury came out with proposals, and these proposals came out on Friday last week, on the 16th of November. And the Treasury proposal is to double the current reporting thresholds to determine whether an entity is large or not. And the exposure draft that they've put out, the comments are due on the 14th of December. Now, the current thresholds to determine whether you're a large proprietary company or not are listed in blue, and then I've also included the proposed thresholds. Before we look at that, the importance of this is if you meet these thresholds and you are a large proprietary company, it means you then have to lodge your audited financial statements with ASIC, which, if ITC 39 goes through, would mean that you would have to lodge audited, consolidated, general purpose financial statements with ASIC. If the thresholds increase this way, and if this goes through, it means that a number of entities that currently are required to prepare and lodge audited financials with ASIC will no longer be required to do so. So these two sets of proposals actually work together, or you should consider them together to consider the potential impact on your organization. And you'll see there's some other proposals that I'll discuss very soon that also comes into play. Now, the current thresholds that we have there in blue have not been adjusted since 2007. So 11 years later, there's another look at it. And the other thing is, in the media release, Treasury has indicated that they believe around a third of our current large proprietary companies, so around 2,200 of the appropriate 6,600 large proprietary companies, will no longer be classified as large and will therefore no longer be required to comply with the financial reporting and audit requirements. Now, it's important to note that small proprietary companies will still be required to keep written financial records, and they may be required to prepare audited financial reports if they are directed by ASIC to do so, or if 5% of their shareholders request that. And all other corporate obligations in terms of the Corps Act that apply to these proprietary companies will continue to apply. And so this is just a proposal around the lodging of audited financials with ASIC. So the current thresholds are, if you meet 2 of the 3 blue ones, you are large. So there's a requirement if your consolidated revenue is more than 25 million, your gross assets more than 12.5 million, and your employees more than 50, you would currently be considered large. Now, the proposed thresholds are if your consolidated revenue is more than 50 million, consolidated assets more than 25 million, and consolidated number of employees, or just number of employees, we don't have to consolidate, more than 100. If you meet 2 of those 3, you would then be a large proprietary company. So basically, they're proposing to double all these numbers. You'll see that BDO have issued an article. If I can quickly get to it, we've released an article. It's also on LinkedIn where we discuss the proposals and we give a little bit more detail on when they become effective. So if you want to read a bit more, you can have a look at that. So you'll see when will the new thresholds apply. The exposure draft is proposing that the revised regulation commences from 1 July next year and therefore apply to financial years beginning on or after 1 July next year. So for 30 June 2019, you'll still apply the current thresholds. So that's the proposal. Oh, sorry, what have I done? I'm getting confused. I'm pressing too many buttons here. I should go back to this. All right. The other regulatory change is around crowdfunding. Now, again, this has some interrelationship with the preparation of general purpose financial statements. Now, small proprietary companies can now access crowd-sourced funding. So if you're a private company and you've got less than 25 million in consolidated gross assets and less than 25 million in consolidated annual revenue, including from related parties, you can now use crowd-sourced funding to raise up to $5 million per year. And I think what's important here, if you use this crowdsourced funding for up to the 5 million per year, you don't have to convert to a public company in order to get access to these funds. And that's a recent and important development for small proprietary companies. Now, there are some implications that we should consider here. And the one is, if more than 3 million funds are raised, and that is a cumulative amount and not an annual limit. So as soon as you raise more than $3 million, as soon as you do that, on the right-hand side, you have to prepare a financial report, you have to prepare a director's report, and you have to lodge this financial report and director's report with ASIC, and an audit is required. So very important to read that in conjunction with the new requirements under ITC 39. So if you raise more than 3 million funds and you are then required to lodge your audited financial report with ASIC, if ITC 39 goes ahead, it would mean you have to lodge general purpose financial statements with ASIC, and those would be consolidated. On the left-hand side, if the funds that you've raised are less than 3 million, you have to prepare a financial report, you have to prepare a director's report, you have to lodge it with ASIC, but an audit is not required. So I think that is very important to see the difference between the two. So you can get access to crowdfunding if you prepare and lodge your financial statements with ASIC. The only difference between the two is whether an audit is required or not. Regulatory changes for not-for-profit entities. Now, for not-for-profit entities, there are a number of interesting ones. So currently, if a not-for-profit entity is registered with the ACNC, The existing thresholds on whether you have to prepare or lodge a financial report and also whether you need an audit or a review on the screen. So if you are small, so your revenue threshold is less than $250,000, no financial report required, and no audit or review required. If your revenue thresholds are greater than 250 but less than $1 million, if a financial report is required and you have to lodge it with the ACNC, but only a review required, not an audit. And if you large, so as soon as your revenue is more than $1 million, a financial report would be required, and an audit would be required. So these are the existing thresholds. So for not-for-profit entities, the proposed thresholds is that if it's a small entity, so your revenue threshold, so it's determined on a rolling 3-year basis. And by the way, I should just clarify that there was a review panel that looked at the ACNC and looked at these thresholds, and these are the recommendations of that review panel. It's not been proposed in any form of exposure draft, invitation to comment, or anything. It's just the recommendations of the review panel, and there's an ongoing process. But the proposed thresholds of this review panel is that an entity should be small if their revenue is less than $1 million. Then no financial report would be required, no audit or review. Medium should be when revenue is between $1 million and $5 million. And that will mean that it's a financial report required and only a review engagement. And large, if it's greater than 5 million revenue, then its financial report would be required and an audit would be required. So potentially some movements in this space as well. I think some other financial reporting recommendations from the review panel is that registered entities should be required to disclose their related party transactions, and that large registered entities should be required to disclose the remuneration that's being paid to responsible persons and senior executives on an aggregate basis, so not individually. So those are just some of the changes or proposed changes. Another very recent development for not-for-profit entities is the deferral of the requirement to fair value peppercorn leases in the financial statements of not-for-profit lessees. Now, currently, AASB 16, paragraph Australian 25.1 requires that not-for-profits have to fair value right-of-use assets that are subject to peppercorn leases. So those would be all leases with significant below market payments. And then the resulting journal could look something like this. If you're a not-for-profit lessee and you've got a peppercorn lease, you will say the fair value of the right of use asset, for example, is $1,000. So we debit the right of use asset $1,000. You'll credit the lease liability, and the lease liability will be the net present value of a peppercorn per year, or the net present value of $1 per year for 30 years. So let's say that is $1. And we will then also say the difference will be credit income of 999. And now you can imagine that in the not-for-profit sector, and that would be private sector and public sector, these numbers could be quite significant. You could have huge right-of-use assets hitting the balance sheet, and then also there's no really lease liability, so huge potential income. And those income amounts, depending on how you apply AASB 1058 or AASB 15, could potentially end up in the P&L on the day that you commence with this peppercorn lease. And these requirements were originally effective for periods beginning on or after 1 January 2019, which is about 6 weeks ago in the future. So we're nearly there. So the AASB last week at their meeting decided to propose that this requirement to fair value peppercorn leases should be deferred. I spoke to the technical director at the AASB, and she indicated that the actual exposure draft is expected to be released within 2 weeks. And what they're saying, the reason that the AASB is deferring this for private sector and public sector not-for-profit entities is that they believe, they've heard, and a number of people have contacted them, that there are some issues around determining the fair value of these right of use assets. So how do you determine the right to use an asset for 100 years if there are significant restrictions on for what purpose you can use this asset? So there is a project on the way to resolve the fair value of these right of use assets, because it's not the fair value of the asset, it's the fair value of the right to use the asset within certain restrictions or limitations. And then the other reason is also, as we've discussed earlier, there is some review going on about the reporting obligations of entities registered with the ACNC, and therefore they don't want to introduce this burdensome requirement if very soon potentially entities will no longer have to prepare and lodge financials with the ACNC. So they're also waiting for that process to come to an end. So all of this is really good news for our not-for-profit clients and for not-for-profit entities. So, this deferral will remain in place until they've sorted out, how do you determine the fair value of the right of use assets, and also, what the financial reporting requirements will be going forward for not-for-profit entities registered with the ACNC. So what will now happen is you'll have a right of use asset that will be measured at the present value of future payments. So the net present value of future payments is potentially 1. The lease liability is 1, no impact on income, etc. And you'll have to have additional disclosures to explain the nature of these peppercorn leases, so users understand that you've got a peppercorn lease that allows you to run your business, etc. So again, last week we've distributed an email to our clients with an article explaining that the AASB defers this requirement. It was also released on LinkedIn, and in our November accounting news, it will also be included. But if you want to look for it, I did put the link there for you. So the next change, regulatory change for not-for-profit entities, are around duplicative financial reporting to end for Victorian incorporated associations. So from the 1st of January, financial statements for incorporated associations will be lodged with the ACNC instead of Consumer Affairs Victoria. It has a potential impact if you've previously lodged special purpose financial statements with Consumer Affairs Victoria. I've given some information there. So if you are one of these entities, incorporated association in Victoria, you can look at these requirements. I think the biggest potential change is that the ACNC determines minimum requirements for special purpose financials. Therefore, entities have to make sure that they meet these. On the right-hand side of the screen, though, when they have published these changes, they've said for these incorporated associations, we'll provide some transitional relief. And I've outlined the transitional relief on the right-hand side. So over the next year or so, they ease you into these requirements of the ACNC. There's also fairly similar relief for New South Wales incorporated associations. So from 1 October this year, um, incorporated associations in New South Wales will now lodge financial statements, will no longer lodge financial statements with New South Wales Fair Trading, but instead lodge their financial statements with the ACNC. There's a similar potential problem around these financial statements have to be special purpose financial statements, and there are certain minimum requirements. And again, on the right-hand side in the yellow block, I've included an overview of the transitional relief that's been made available. So again, for the first year, you can do what, for 30 June 2018, you can lodge whatever you used to lodge with New South Wales Fair Trading. For 30 June 2019, you have to comply with certain requirements, but the minimum requirements, but no comparatives required, so you don't have to go and restate the previous financials. And then from 2020 onwards, you have to meet the minimum requirements, including comparatives. So it's similar transitional relief for incorporated associations in Victoria and New South Wales. And then for not-for-profit entities in the public sector, the AASB approved implementation guidance for not-for-profit public sector licensors, and I've provided a bit of an overview of that for you if you're in that space. If we go on, and there's so much to cover in this annual update, so please excuse me for moving on and not looking at everything in great detail. I've tried to still prepare comprehensive PowerPoint slides that if there's an area that's of particular interest to you, you can look at that in more detail at your own time and at your leisure. Focus areas of regulators, as I said, ASIC has not yet released their focus areas for December 2018, but these focus areas stay fairly stable over time, and therefore we've based it on their June 2018 media release. I think a big focus area, not just for ASIC, but it seems to be for all the global regulators, is first of all the disclosure of the impact of the new accounting standards. So if you have already adopted IFRS 9 and 15, so if you get to 31 December 2018, it would have been for for-profit entity the first year of the mandatory adoption of IFRS 9 and 15, and you have to disclose the impact of the adoption of those standards and the impact it had on your financial statements, and they're looking for that. And that's very important. So that's the first bullet point. The second bullet point is you also have to disclose the potential impact of new accounting standards that's been issued but not yet effective. The best example there is IFRS 16 that's becoming effective for years beginning on or after 1 January 2019. And if you've got multiple leases and if you've got long-term leases with a number of extension options, it will have a big impact for you. And there's also an expectation that you would be able to quantify the impact of these standards. So if you would like us to assist you with IFRS 16 impact assessment, BDO has a tool that can do that, BDO leads, so please contact me about that. In the third bullet points, you should consider the impact that these new standards will have on other items. For example, your financial covenants, your tax liabilities, your dividend policy, your remuneration schemes, and whether you need new systems and processes. So very important that there's an assessment of that so you're prepared. Also, a reminder that directors and preparers should be mindful of their legal obligations. You would have seen that last month I've issued an article with the Australian Institute of Company Directors on questions that directors should be asking management and finance teams around IFRS 9, 15, 16, AASB 1058. So that's a good article to look at. And I've also discussed it in last month's webinar. I think it's important to note, and ASIC flagged that investor and market confidence in an entity improves if the entity implements the new standards in a timely manner and discloses the impact publicly. So I think it's very important, if you know there's going to be an impact, to assess the impact, disclose it in a timely manner, keep the market informed. And therefore, ASIC also issued a reminder to directors and preparers around their continuous disclosure obligations to keep the market informed, as well as the impact on any fundraising and other transaction documents. So these were all reminders that was included in the June 2018 media release around responsibilities around these new accounting standards. Now, we have seen internationally, when we looked at global enforcement priorities for 2018 annual reports, and remember, globally, certain countries like Canada have quarterly reporting and they comply with IFRSs. In Europe, the bigger entities have half-year reporting. 30 June 2018 would have been the first half year. Most of them have 31 December year ends. And there were a lot of regulators taking note and issuing statements around the application of IFRS 15, because it's been the first year of mandatory application internationally or globally as well. Have we properly identified and considered the satisfaction of performance obligations? Have we done a proper assessment of the distinction between principal versus agent? And that's a big area, and there's specific application guidance in the appendix to IFRS 15. Have you done a proper allocation of the transaction price to multiple performance obligations? There's also comments and questions around the presentation of contract assets and contract liabilities on the date of transition. A lot of questions around the disaggregation of revenue disclosures. So IFRS 15 has a number of additional disclosures, and to what extent has that been done properly? A lot of emphasis on disclosure objectives of IFRS 15, and also the disclosure of significant judgments made and key assumptions used. And as we've discussed over the last 2 years, when we discussed IFRS 15 in our monthly webinars, a lot of judgments required, a lot of assumptions that have to be made, and that has to be disclosed. These regulators have also mentioned, obviously, IFRS 9, because the two new big mandatory standards, IFRS 9 and IFRS 15. So the reclassifications of financial assets and liabilities on initial application of IFRS 9. So we have discussed there were classifications, especially assets under AASB 139, that is different to the classifications under IFRS 9. Very important, we know there's a lot of differences around impairment allowances, and have we disclosed a reconciliation of the old impairment allowance to the new impairment allowance? Also, questions around interest revenue. And often when we speak to clients, there seems to be quite a bit of confusion whether interest revenue is within IFRS 9 or IFRS 15, and whether interest, when would fees be part of the effective interest rate calculation in terms of IFRS 9, and when would fees be accounted for under IFRS 15. And then again, the disclosures regarding key judgments and how expected credit losses and changes in credit risk are determined and disclosed, especially for loan receivable balances. Other things that the global regulators have been looking at is the disclosure of the expected impact of IFRS 16, also environmental matters, including climate change risk. So impacts on the business model from the need to shift from a carbon intensive to a low carbon technology. And then also some questions and notes around alternative performance measures. I think a number of entities highlight certain items, performance items, as non-recurring, and there's some guidance on to what extent non-IFRS measures can be highlighted, never more prominent than IFRS measures. So those were, I would say, grand themes from the regulators, including ASIC, and definitely a theme would be IFRS 9 and 15, mandatory adoption and disclosure of the impact, but also expected impact of IFRS 16. Um, if we go on to the next section and we look at accounting standards effective for the first time for the year ended 31 December 2018. I'll start with a bit of a summary of those standards that has a mandatory impact for for-profit entities. So if you look at standards, it's IFRS 9 and IFRS 15. If you look at amendments to standards, it's amendments to IFRS 2, and then also the annual improvements that's been made in the 2014 to 2016 cycle. And then there's a new interpretation, IFRIC 22, that we'll discuss very briefly. For not-for-profit entities, new standards is only IFRS 9 because IFRS 15 has been delayed for a year to become effective at the same time as AASB 1058. And there's a new interpretation for not-for-profit entities. So you'll see often not-for-profit entities, the implementation of the standards are delayed by a year to allow the AASB to consider the impact of new international standards and interpretations on not-for-profit entities in Australia and for those not-for-profit entities to get ready. So that's why there's a bit of a difference. So if we look at IFRS 9 financial statements, now we've done numerous webinars over the last 2 years around IFRS 9, and I think it's about 6 or 7 of them. So therefore, I've prepared slides that are very high level. And, and it's definitely not comprehensive, not good enough, but very high level questions, things you should be aware of. Around financial measurement of financial assets, definitely far more fair value. If you look at impairment, it's now an expected credit loss model, and it should lead to larger bad debt provisions and also the recognition of those provisions at an earlier date. Hedge accounting, easier to achieve hedge accounting. Transition to IFRS 9, including the transition disclosures, are very complicated, and it will take a lot of time to get it right. And then interaction with IFRS 15, especially around loan receivables and fees, it's complicated and should be assessed very carefully. If you look at measurement of financial assets, key points to consider, certain loans or loans that fail the SPPI test solely for the purposes of principal and interest must be held at fair value. So examples would be loans where there are bonused interest payments that depends on a project or an asset. So there are certain fixed interest payments, but you'll also get bonus interest payments if the project is successful. Now, those loans would fail the SPPI test. Often loans that are made to startups is likely to fail the SPPI test. And loans that will be sold will fail the SPPI test. So if you look at measurement of financial assets, you have to be careful and assess whether those financial assets meet the SPPI test. Important to note, when you look at unlisted equity investments, remember you no longer have the choice to put it at cost. All these unlisted equity investments now have to be measured at fair value. That's a big change. And all equity investments, including unlisted equity investment, you've got a choice to account for the change in the fair value through profit and loss or through OCI, and that's an irrevocable election on an asset-by-asset basis. Remember, we no longer have the problematic available for sale financial asset. If you look at still impairment of financial assets, things to consider around trade receivable, a predicted loss model is required. You're not allowed to use a general provision. And you need to be able to generate sub-portfolios And there's also, it's important on a sale purchase agreement, because parties may have different measurement bases. If you look at loans to joint ventures and associates, a big area that you should focus on. If you've got a loan receivable from a joint venture or an associate, the three-step approach, the stage 1, stage 2, stage 3, should be applied. You need to be able to identify loans where there's been a significant deterioration in credit risk. You should come up with the triggers on when would you move from stage 1 to stage 2 to stage 3. And there could be significant issues for startups in explorers to be able to do that. And then also for intercompany loans, in the parent entity, in the separate financial statements, you also have to apply the three-step approach. So you can't just say intercompany loans eliminate on consolidation, a very specific requirement to look at the impairment of those intercompany loans in parent entity financials. Another point that I thought I should just remind you of is renegotiated loans. Now, you'll know that if we have a financial liability and we renegotiate the terms or there's a modification, we've always asked the question whether it's a substantial modification or a substantial change with substantially different terms. If it is, you de-recognize the existing financial liability and you recognize a new financial liability. If it's not substantially different and it's not a substantial modification, you adjust the existing financial liability. Now, what's important to note is under IFRS 9, there's only one acceptable way to adjust the financial liabilities where the terms are not substantially different. And that is to adjust the carrying amount of the liability. And if you adjust the carrying amount of the liability, it will result in a gain or a loss on the date of the modification. Now, previously, if it was not a substantial modification under IAS 39, and that's what most people did, they recalculated the effective interest rate. There was no gain or loss at that date, and the new effective interest rate was spreading those new cash flows and the interest expense over the remaining period of the loan. So this is a big change. If you're renegotiating loans, this is a big change to be aware of, and just a reminder of that. If we go on and we look at some key themes in IFRS 15, now again, we've done numerous webinars on IFRS 15 over the last 2 years. You can go and look at those recordings. You can download the PDF of the slides. So do you remember the 5 steps? So you have to work through these 5 steps in a systematic manner for each and every revenue stream. So step 1, specifically a problem area around contract modifications or variations. Quite often we see this in construction industry. Can you identify these modifications, variations? Is the modification distinct? And then also, what about extensions and modifications of service contracts? Do you understand the complexities of those? If we look at step 2, we have to look at distinct performance obligations. Now, can you identify all the distinct performance obligation? Do you know when to combine activities into one performance obligation because there's a certain level of integration, installation required? I think important, I want to flag in the block here, the big blocks here, there's 2 parts here. You know, you have to consider whether the performance obligation is distinct within the context of the contract. And there it's very important to look at the basis for conclusion, paragraph 116, capital K. And the question is there a transformative relationship between the items in the process of fulfilling a contract? So if it's just a functional relationship, we'll have separate performance obligations. However, if it's a transformative relationship, we'll have one performance obligation. Now, that whole concept of the difference between a functional and a transformative relationship you can see in basis for conclusion 116K, and I would definitely recommend that you look at that. And then, can the customer benefit from this performance obligation on its own? So mobilization fees, joining fees are not separate performance obligations. Another thing that I thought I should flag is around material rights. So material rights to renew, etc., or free goods or services. Can you identify them? Do you know what to do with them? And also warranties. Do you know the difference between a service warranty and an assurance warranty, and what the different accounting treatment is? So there's a change from how we currently account warranties under AASB 137. Some warranties, the accounting treatment, the assurance warranties, the accounting treatment will be the same, but for service warranties, they will be a separate performance obligation. Step 3, where we look at determining the total transaction price. Do you understand the reversal constraint? Do you understand how penalties and awards work, and whether it's highly probable that you'll have to pay the penalty or receive the award? Do you understand step pricing arrangements or volume discounts and all other price concessions, and how that links to determining the transaction price? In step 4, we look at allocating the transaction price to different bundled performance obligations. We look at how do you allocate discounts to different performance obligations, and we also look at how do you allocate variable consideration to different performance obligations. Now, in step 5, we finally look at recognizing revenue at a point in time or over time. So it's quite often less revenue may be able to be recognized over time. If you look at construction contracts, you have to ask, where is the work being performed? And please note, and I've put it in red, if you recognize revenue over time, it does not result in WIP, work in progress. So if you end up with overtime revenue recognition and you have WIP, there's something wrong. And then when you have bill and hold arrangements, it's actually very difficult to recognize revenue. So these are very high level questions to remind you of some of the things we've discussed over the weeks and months in the webinars. Transition, have you decided on a transitional approach? Cumulative, retrospective, a retrospective method with practical expedience. And there are a number of practical expedients that you could use. Some of them only apply to the cumulative approach. Some of them only apply to the retrospective approach. But these are all the things to consider. Something that I want to look at next, which is something we haven't covered before, and therefore I want to spend a little bit of time on this one, is the recent changes or amendments to IFRS 2. So there are changes around cash settled share-based payment transactions, first of all. So the question was, what is the impact of vesting and non-vesting conditions when you measure a cash-settled share-based payment transaction? And you remember, if it's a cash-settled share-based payment transaction, you recognize a liability because you're going to ultimately settle in cash. And the question is, so what impact does vesting and non-vesting conditions have? And they say, or the change clarifies, that you account for your vesting conditions, whether market or non-market, and also non-vesting conditions, in the same way as you would if these were equity settled share-based payment transactions. So what does that mean? If you've got a non-market vesting condition, for example, there's targeted sales or a targeted profit, it will have no impact on fair value of your cash settled liability. You'll adjust the number of awards that's expected to vest. If it's a market vesting condition, for instance, targeted share price, you'll adjust the fair value at each reporting date until settlement. And if it's a non-vesting condition, so for instance, a future commodity price, again, you'll adjust the fair value at each reporting date until settlement. The critical thing is that you'll see as a result of these changes or the underlying principle that your cumulative cash settled share-based payment expense that you recognize over time will in the end equal the cash that you pay when you get to settlement. There's also been questions around what do we do if an arrangement, a share-based payment, changes from cash settled to equity settled? So what do we do in that situation? So first of all, you'll measure the equity settled transaction, share-based payment, at the fair value of the equity instruments that you've granted. Then you'll de-recognize the cash settled liability, and then you'll recognize the difference between number 1 and 2 immediately in profit or loss. So this is where you have a cash settled arrangement that turns into an equity settled arrangement. Now, in our view, it's unlikely to have a widespread impact in practice, but if you find it, this would be the appropriate accounting treatment. Another change, or the third change or amendment to IFRS 2, is around the net settlement feature to deal with withholding tax obligations. So really the principle here is, even though you may be required to withhold a portion of an equity instrument from an equity settled share-based payment arrangement, and the reason you withhold it is to settle a withholding tax obligation, which will be settled in cash, the whole arrangement will still be classified as an equity settled share-based payment transaction. So you're keeping a part back. It's an equity settled share-based payment. However, you have to keep a part back in order to pay the withholding tax in cash. Now, the fact that you have to pay that withholding tax in cash doesn't change the fact that it's an equity settled share-based payment transaction. Now, the next item that is mandatory for 31 December 2018 is annual improvements. Now, there's been annual improvements to IAS 28 and annual improvements to IAS 40. Now, if you look at IAS 28, which is looking at investments in associates, first of all, on the blue side, venture capital organizations, mutual funds, unit trusts, and other similar entities may elect to measure investments in associates and joint ventures at fair value or use the equity method. So there's an accounting policy choice. And this election is available on investment by investment basis. On the right-hand side, the yellow part, if an entity that is not an investment entity may decide to retain the fair value measurements that's been applied by its associates and its joint ventures that are investment entities. And again, this election is available on an investment by investment basis. So if you have to incorporate associates and joint ventures into your financial statements, and those associates and joint ventures are investment entities, and therefore they've accounted those investments, their investments at fair value, you can continue to do that. You don't have to back it out. So that is a huge assistance. If we look at the amendments to IAS 40, now there's always been guidance in IAS 40 investment properties on when do you transfer items in and out of investment property. So for instance, this is the existing guidance. When you transfer from investment property to PPE, the evidence was the owner occupation started. Or when you transfer something from investment property to inventories, when would you do it? When development is started with a view to sell it. When would you transfer something from PPE to investment property? When the owner no longer occupies the PPE. Or what about inventories to investment property? When there's commencement of operating lease to another party. So this is the guidance we had in the current IAS 40. Now, what they've done is they've added some additional guidance. And the whole purpose here was to just clarify that this list was never meant to be an exhaustive list of indicators. They're only indicators, and they're only examples of evidence that could indicate that there's a change in use. So it's important to note here that you don't have a change and a transfer if there's a change in management's intention on how they want to use a property. We need some actual evidence that support that this has actually happened. There's been a real change in use. So it's not management intention. We need evidence that indicates a real change in use. So they've added, if you have an investment property that changes to owner-occupied property PPE, if there's development with a view to owner-occupy, for example, a transfer might occur when the lease is terminated and there are firm plans in place to redevelop the site to suit the client's specific needs. So we haven't started to use it yet, but we're busy refurbishing, renovating in order to use it. That's enough. And inventories from investment property, as soon as we enter into an operating lease with another party, then we could say it's now investment property. The other change is in interpretation, and there's a new IFRS 22. Now, this one is a very interesting one, and I've got 2 slides. I'm just aware that my time has run out. For those of you that have to leave, please feel free. You can always come back and pick up the recording after an hour and watch the rest. For those that can stay, I'll try to finish within the next 15 minutes. Unfortunately, an annual update, there's a lot to cover. IFRS 22, I think, can have an impact in our client base. So the question, and I'm going to skip this slide, that's a little bit of introductory, and I'll show you an example instead. So what happened here is on the 1st of January, Entity A enters into a contract to purchase a machine for $100,000 US. The payment must be made on the 1st of April, and the machine will only be delivered on the 30th of September. And now they also provide the exchange rates to us. And you can see there are exchange rates on the 1st of April, the 30th of June, the 30th of September, and the entity has an Australian dollar functional currency. Year end is 30 June. The question is, what are the journal entries? Now, normally, you receive the machine first, and you normally account for that machine at the spot rate at the date that you receive the machine. However, in this example, for some reason, you pay upfront and you only receive the machine a number of months later. So should you now account for this machine at the spot rate when you pay, or should you account for the machine at the date, the spot rate at the date that you actually take delivery of the machine? That's the question. And what they've said in this interpretation is you look at the spot rate at the date you make the payment. So what would have happened here is on the 1st of April, you would have paid 133,000 Aussie dollars. You would have said credit cash, debit a prepayment. And then on the 30th of September, you receive the machine, and you don't measure the machine at the spot rate at that date because you've already paid for it, and therefore you say debit the machine with whatever is in the prepayment. So this is a very important clarification. This also works when you have deferred revenue, and I think that's where I've seen it most often in practice, where you receive an amount of cash. Let's say on the 1st of April, you receive the cash, you say debit cash, and you say credit deferred revenue, because you'll only provide the service, let's say, in 6 months' time. Then in 6 months' time, when you provide the service, you should just release that original deferred revenue that you've booked to revenue. You should not measure the revenue at that date, at the spot rate at that date. So this applies to prepayments, and it also applies to deferred revenue, and in a very important interpretation. If we look at accounting standards that's been issued but not yet effective for for-profit entities, the big ones, IFRS 16 and IFRS 17 insurance contracts, there's also been a number of amendments to standards around the definition of a business in IFRS 3, definition of material in IAS 1 and 8, annual improvements, etc. And there's a new interpretation, IFRIC 23, uncertainty over income tax treatments. So for-profits, quite a number of them that are not effective for 31 December 2018, but will be next year. And we'll look at them in more detail at a later stage. For not-for-profit entities, even more, because 15 and 1058 has been delayed. There's been amendments to other standards that has also been delayed, for example, the amendment to IFRS 2, and also the new interpretation, IFRIC 23. So I want to end today's webinar by looking at IFRIC 23, because I think although it's been issued not yet effective, it has some very important implications for our clients. And therefore, I would like to look at this. Again, if it's not relevant to you, you're welcome to leave or obviously watch the recording. So if you look at IFRIC 23 or AASB Interpretation 23, for annual reporting periods that begin on or after 1 January next year, IFRIC 23 will require entities to calculate the current tax liability in their financial statement as if the tax authorities, so in Australia the ATO, was going to perform a tax audit, and the ATO knew all the facts and circumstances about the entity's tax provision. So what issue does IFRIC 23 clarify? It clarifies how and when to apply the recognition and measure requirements in IAS 12 income taxes when there's uncertainty. And I think what's interesting to note is that US companies have been subject to this. Oh, I don't know what happened. US companies have been subject to these rules for a number of years. Because they had a US standard called FIN 48. Now, this interpretation is not likely to be welcomed by preparers of financial statements because it will likely result in higher current tax liabilities being recognized at an earlier date for uncertain tax provisions. Now, currently, there is divergent practice, with many entities taking an optimistic view and factoring in the probability of having a tax audit, as well as the outcome, rather than accounting for the worst case scenario. So the accounting has to be for the worst case scenario and not that overly optimistic view, and not factoring in. You should not factor in whether you'll be subject to a tax audit or not. So why do we have uncertainties over income tax? Now, I'm sure the tax partners will tell you that quite often the Income Tax Act is not clear, and tax law is not clear, and therefore there could be a lot of uncertainties around different interpretations of the tax law. You know, and because the law is unclear, entities would be required to make an estimate prior to these uncertain positions being accepted by the tax authority. So disputes and tax audits could therefore have a significant impact on amounts that's recognized in income tax expense and in your current and deferred tax liabilities. So it's very important that IFRIC 23 clarifies how these uncertain tax positions are to be measured in the financial statements. Issues addressed by IFRIC 23, so there are 4 particular issues. Whether an entity considers uncertain tax treatment separately. I don't know why it goes so fast. The assumptions an entity makes about the examination of tax treatment by tax authorities. How an entity determines taxable profit or loss, tax bases, unused tax losses, unused tax credits and tax rates, and also how an entity considers changes in facts and circumstances. So I'll look at them individually. So are uncertain tax treatments considered separately? And they've decided here that, or IFRIC 23 says that you have to use the approach that best predicts the resolution of the uncertainty. So you have to take into account how an entity prepares its income tax return and supports its income tax treatments, and also how the entity expects the tax authority to examine and resolve the issues. So will it be separately or together? So in some cases, uncertain tax treatments would be considered individually, and in other cases on an aggregate basis with other uncertain treatments. So this could be complicated in practice, if these uncertain tax positions are interdependent. So the other thing to be careful of is that you will have to assume that a tax audit will be conducted. Very important. You should not consider the probability of a tax audit. You should assume there will be a tax audit. Oh, the slides are jumping around. So assume that the authorities will perform a tax audit and that the tax authorities will have full knowledge of all the facts and circumstances. And it's very important that you ignore the probability of having a tax audit when calculating the amount of tax owing, where that tax treatment is uncertain. So when is the effect of the uncertain tax position reflected in your tax calculation? You'll reflect it if it's probable, so a more than 50% chance that the tax authority will accept an uncertain tax position. So the entity should only reflect the effect of uncertain tax positions in a calculation if it's probable that the tax authority will accept it. If the entity consider it probable the tax position will be accepted, the income tax amounts are measured consistently with the tax treatments to be used when the tax return is prepared after the financial statements are authorized for issue. Important to note, if it's not probable that the tax authority will accept the tax position, what do we do now? Here you can use either the most likely amount or you could use the expected value method. So just go up. So most likely amount would be, which is the single most likely amount in a range of possible outcomes, where the expected value method, it would be the sum of the probability weighted amounts in a range of possible outcomes. If we look at what if facts and circumstances change? Now, it's important that if facts and circumstances change, that you reassess your judgments and your estimates to determine whether it is really a change in the facts and circumstances or there's new information that's become available. Now, it's important where the tax authority has neither agreed or disagreed with the tax treatment, it's likely to be considered a change in facts and circumstances that would warrant a change in an estimate of the tax balances. However, changes to amount recognized for an income tax expense and current and deferred tax assets and liabilities are then recognized prospectively as changes in estimates under IAS 8. So important to know, is it a change? Do we reassess? Is it a change in estimate or do we have new information? Very important to look at that. If you look at disclosure, consider if disclosure of uncertain tax treatments are required as a significant judgment. And if it's probable that a tax authority will accept uncertain tax treatment, entities must also consider disclosing the potential effect of those tax-related contingencies. So a recap of this webinar, I've tried to group it into different categories, one being the regulatory changes for for-profit entities, the other the regulatory changes for not-for-profit entities, the focus areas of regulators, Accounting standards effective for the first time for the year ended 31 December 2018. Accounting standards that's been issued that's not yet effective, and a very brief overview of the requirements of IFRS 23, although it's not mandatory yet. So if you need assistance, you can look at our recorded webinars. Our next webinar and our last one for the year is on IFRS 16 problem areas. We also have newsletters. You can register on our website to receive our monthly accounting news. And we also have other technical resources, IFRS in practice, etc. Technical advice, please contact any of us if you need advice. This is the big team. Any questions, please feel free to contact me. And I just want to say thank you very much for joining me for this very long webinar overview of the changes for 31 December 2018. I hope you found it useful, and we'll speak again next month. Thank you very much.